two real issues, inflation or lack thereof, and balance sheet. Let's start with balance sheet. They said relatively soon they're going to start rolling off the balance sheet. People are interpreting that as September. Is that what you think is going on, and what does it mean?
I definitely think it's September. I think they've been pretty clear in their rhetoric. So, for example, Yellen in her testimony made it clear that they're not particularly worried about the economy for that decision, and I think they're all set up for September.
And so go to what it means as a practical matter. As they roll it off, it's going to be gradual, so it won't be abrupt. Yes. They keep saying that. But how does that change, for example, the tenor of notes that people are going to be holding out there?
So first of all, they're going to be essentially putting out more long-term Treasury securities and mortgage-backed securities into the market over time as they stop purchasing those things. Moreover, the reserves which banks hold at the Fed, which have been very, very large, are going to start to shrink. Ultimately, that means the private market has more duration. That has to mean the price of duration is going to go up. Basically, that means a steeper yield curve over time.
And it shifts the risk of interest rates to the private market, essentially.
Absolutely.
If you're having a longer tenor, you're going to have to bear that interest. So, Mislav, what does that mean as a practical matter in the bond market?
In terms of the impact of all of this for the bonds and for equities, we think bond yields will be grinding higher in the US, but not very aggressively. And for the equities, which is my key concern, it's the issue of this whole asset reflation story that we had for all these years. A lot of people say it's not going to have much of an impact. Market will shrug it off. I'm worried to some extent because the last time we had tapering, as we said in 2013, S&P 500 traded on 13 times forward and Eurozone on 11 times forward. Equity markets are right now 25 to 30% more expensive, and therefore this risk reward is not so great.